Welcome back to Economic Insights. We already talked about what it means for an ordinary country to default on its debt, but the US is not like other countries, and the US dollar isn't like other currencies. Is the US on the brink of default? If so, when might it happen? What would this mean for the global economy and for you? To understand this, we will delve into the roots of the US debt and the preconditions under which the default may really happen. The US government spends more than it earns for quite a while. Actually, in the last 50 years, the federal government budget has run a surplus only 5 times, most recently in 2001. The budget deficit on average over the past 50 years was 3.5% of GDP. In 2021, it exceeded 12% of GDP. To pay for government programs while operating under a deficit, the federal government borrows money by selling US Treasury bonds, bills, and other securities, which are, by the way, considered among the safest investments worldwide. The national debt is the accumulation of this borrowing, along with associated interest owed to investors who bought these securities. At the end of fiscal year 2022, federal debt held by the public was about 100% of the GDP, while over the past 50 years on average it was only 46% of GDP. Spending for social security and federal health care programs in particular has been a significant driver of the deficit. Rising healthcare prices and an aging population demanding more care are putting pressure on the budget. Higher interest rates combined with rising debt also increase deficits. So the debt is on the rise. But there is a limit to how much the US can borrow, known as the debt ceiling. The debt ceiling is set by Congress. If the US needs to borrow more than the limit, Congress has to approve an increase. If Congress doesn't raise the ceiling in time, we face the risk of the US defaulting on its debt. Since the US dollar is the world's primary reserve currency, a default could create chaos in international markets and economies. If it happens, it could make the 2008 global financial crisis feel like a walk in the park. During the 2011 standoff over raising the US debt ceiling, the S&P 500 index of leading US shares plunged more than 15%. The index kept falling even after a deal was reached, which happened just hours before the government ran out of funds. Fitch has already placed America's AAA credit rating, its highest score, on watch for a possible downgrade because of the political brinkmanship. The move brought back memories of 2011, when S&P downgraded the United States from AAA to AA+. S&P has still not reinstated that perfect credit rating more than a decade later. Any downgrade, however small, affects the pricing of trillions of dollars of US government debt and causes future borrowing costs to rise. US mortgage rates have already jumped amid the uncertainty surrounding the debt ceiling increase. There is no historical precedent for a US default, making it impossible to predict how it would unfold. In one scenario, to which experts assign 10% probability, the United States could avoid technical default for a few weeks by continuing to pay bondholders at the expense of other budget items, such as spending on social security benefits and healthcare. That would be what Moody's analytics call a breach of the debt ceiling. A breach is not as serious as default. But even in the event of a breach lasting no more than a week, US gross domestic product would decline by 0.7 percentage points and 1.5 million jobs would be lost. If the political deadlock drags on through the summer, GDP would plunge 4.6%, costing almost 8 million jobs. Stock prices would collapse, wiping off 10 trillion household wealth, and borrowing costs would spike. A deep recession in the United States caused by a prolonged breach or a US default would sink the global economy too. The financial panic would cause credit markets to freeze up and stock markets to plunge. However, the US, as the issuer of the world's primary reserve currency, is in a unique position. The dollar comprises up to 60% of the official foreign reserves. About 60% of international and foreign currency liabilities, primarily deposits and claims, primarily loans, are denominated in US dollars. the share of US dollar in foreign exchange transactions is about 90%. The American technological, military, economic, and diplomatic strength underpins the dollar's dominant role in international trade, banking, and investments. This makes the possibility of a US default outside of a political decision almost zero. While we may feel comparatively safe in the short term and mid-term, and may even use the current situation as a buying opportunity, in the long run there should be a bold solution found. US Government Accountability Office warns that the nation is on an unsustainable fiscal path, and the underlying conditions driving this gloomy fiscal outlook existed well before the pandemic and the war. Going forward, spending, including for Social Security, Medicare, Medicaid, and net interest on the debt, is projected to continue to outpace revenue by increasing amounts. While most economists and policymakers say the US is unlikely to default, the recurring drama around the debt ceiling does raise questions about the future stability of US financing and the world economy. Addressing the root causes of the rising debt, like healthcare costs, will be crucial for long-term economic stability.